Okay, Assalamualaikum and good day to everyone. So today we are going to learn about the capital budgeting. Okay, from this chapter, you can understand importance of capital budgeting, and you can count the accounting rate of return and payback period. You can also understand the time value of money and compute the net present value and internal rate of return. Okay, so first, what is capital budgeting? So capital budgeting is decision that involve broad strategic aspect of company where manager analyze alternative long-term investment. Okay, manager need to analyze the long-term investment. So through the capital budgeting, so manager can identify which project the manager want to accept or reject. So example of capital budgeting is when you launch a new plan or you expand the plan, and then you purchase new machinery or replace any equipment. Okay. So nature of capital budgeting decision, you have three, which is outlays of large amount of resource. Okay, outlays of large amount of resource. So outlays of large amount of resource means that because when you do the capital budgeting, you incur very large amount of fund. So if the investment decision turn out to be mistake, so it will badly affect your company. Okay. And then B, non-reversible. When you incur the investment, okay, so of course you cannot easily reverse it because it involves very large amount of fund. Okay. And then strategic and risky. So due to large amount of resource involved, capital investment decision usually have long-term effects on the sustainability and growth of the company. So major investment decision, if not all, have to be approved by BOD. Okay, the analysis of capital investment alternative involve focus on various factors, such as you have to forecast the company operation, any changes in government policy. So any uncertainty with this forecast when the investment stretch out will affect the future. So there are 5 steps. You first have to identify potential capital investment, forecast future net cash flow, analyze and choose alternative. Lastly, you have to perform post audit after making the capital investment. Okay, there are 2 main types of capital budgeting decision. First, you have to screen decision. Okay, you got the proposed investment, so you have to screen it whether it is acceptable or not, and then attempt to rank those alternative from the most to least appealing. You kena choose whether the alternative is make profit to your company or not. So daripada yang paling very good one to the least one. So method used to evaluate capital expenditure decision. Okay, are the 4 methods, which is using accounting rate of return, payback period, net present value, and IRR, internal rate of return. So from this example, okay, you have the investment of 1 million. Product life cycle is 5 years. Okay, so should Mata invest in this project? Okay, already given to you the net income, which is 126,000. So accounting rate of return, the formula is average annual net income divided by initial investment divided by 2. You will get the ARR, accounting rate of return. So from the income statement previously, you get the 126,000. Okay, the net income divided by 1 million over 2. So the accounting rate of return will be 25.2%. Okay, so the rule of the accounting rate of return is you have to accept it if the company target if it is greater than the company target rate of return. Kalau target rate of return more than berapa tadi? 12 berapa persen tadi? Okay. If the target rate of return more, so you have to make sure that you accept project which is less than the target rate of return. Okay. So accounting rate of return, you have those pros and cons. Where pros, you have simple, intuitive, and cons, you ignore the time value of money concept. And the accounting rate of return is based on net income. And the alternative accounting method may have an impact on reported net income. So, the typical cash outflow. Apa yang menyebabkan cash outflow? Okay. First, initial investment. Of course, when you want to incur the investment, you have to incur cash outflow. And then additional amount of working capital, repair and maintenance, and additional operating costs. All of this is the typical cash outflow. Okay. And then incremental revenue, reduction in cost. When you want to increase your revenue, of course, you have to incur something in order to increase the revenue. And then salvage value. Salvage value means the depreciation. Okay. And then release of working capital. You have to allocate some amount of money in order to purchase any equipment. Okay. So capital expenditure decision. Okay. Same question just now. Okay. 1 million is the investment. The life cycle is 5 years. Net income is 126,000. So, to differentiate between cash flow versus accounting net income, so net income is 126,000. You have to plus the depreciation. How you get the depreciation? 1 million divided by the useful life. You get the 200,000. So, the net cash flow will be 326,000. Okay. Okay. Payback period. What is payback period? It is the period of time you take in order to cover your initial cost. Okay. The basic premise of this method are the more quickly, the more desirable. Okay, lebih cepat, lebih bagus. So, decision rule, you have to accept if its payback period is shorter than the company target payback period. So, usually in the question, I will give you two different projects. So, you calculate the payback period. So you determine which one which of the project have the shorter time period in order to cover up its initial cost. Okay, so payback period, initial investment divided by annual net cash flow. So you will get the payback period. Okay, annual net cash flow, same lah, net income you have to plus depreciation. So 1 million divided by annual net cash flow, you get 3.07 years. So this is the payback period of Mattel company. Okay. Okay, when annual cash flow are unequal, bila tak sama, okay, the cash flow, you have to minus. For example, from year 1 until year 5, investment you 1 million. Then you minus the net cash flow, 250. So you will get 750,000. Then you bring down to year 2. And then the list will continue until the final year, year 5. Okay. So you already cover up all your starting investment. So how you want to count the payback period when your cash flow are unequal? You determine any unpaid investment. You find out that in year 5, you already cover all the investment. Meaning to say that you can cover within year 3 and year 4. You see? Year 4, you already get the negative unpaid investment. So, year 3, you have to plus 110,000 from year 4 divided by 375,000. Okay, you get 3.29 years, your payback period. Okay, your pro and cons. Your pro, fail to consider time value of money, whereas cons, provide simple and intuitive tool. pro, you does not consider project cash flow beyond the payback period. And for cons, okay, it may essential that investment can cover its initial cash outflow as quickly as possible. Okay, time value of money, you have learned from the previous chapter. Time value of money means 1 ringgit today is valuable than what you can receive after. For example, you receive 1,000 today, you can invest 10%, then it worth 1,100 in 1 year. Okay, discounted cash flow. Discounted cash flow, okay, you can use NPV and IRR, net present value and internal rate of return. Okay, what is net present value? Net present value emphasize on discounted cash flow. Okay, the accounting net income is based on accrual, which ignore the timing of cash flow into and out of organization. Okay, net present value, you can use this formula. Okay, CF0 is the initial amount plus cash flow. K is the discount rate. K, so you can use this formula for net present value. Okay, so decision rule under net present value, either positive, 0 or negative. If positive net present value, you can accept. 0 is still acceptable, whereas negative is not acceptable. Okay, net present value. Okay, net present value, example here is same lah, sama tadi, net income 126,000. Okay, but using net present value, you have the required rate of return, which is 12%. So, using the net present value, you can refer to the table. Okay, table time value of money kan. So 12% and then 1 year, we will get the PV factor. Okay, and then total out of net present value will be 175,165. So equal annual cash flow. Okay, net present value, you take the initial investment minus total present value. So you get the net present value of 175,165. The present value factor is the total amount of the present value factor tadi. Okay. Okay, now internal rate of return. Internal rate of return is the true economic return earned by asset over its life. So it can compute by finding the discount rate. Okay, so the formula for net present value, internal rate of return is this one lah, cash flow over 1 plus IRR. Okay, so decision rule, when in IRR more than required rate of return, positive. IRR equal to required rate of return, 0 NPV. IRR less than required rate of return, negative NPV. So, in order to find the IRR, you have to divide investment required over net annual cash flow. So, the present value factor will be 3.067. Okay, then you can compare net present value and IRR. Okay, net present value, any project with negative net present value is reject. But for IRR, to be acceptable, a project rate of return must be greater than the cost of capital. Okay, you can compare NPV and IRR methods. Okay, profitability index. Profitability index. Okay, so ada 3 projek dekat sini. So, how to find the profitability index? You have to divide present value of future cash flow divided by initial investment. Okay, profitability index, present value divided by initial investment. So, the higher, the more desirable. So, from this project, you see which one? The highest. The highest is project A. So, you should choose the project A. Okay. So, this is an additional consideration you have to consider before you want to choose the project. Okay, you can read. Okay, that's all. Okay, this is the post audit of investment project. Thank you.